Starting with the first candle, the candle range theory states that every candle's high and low serve as key liquidity levels that upcoming candles will often target. The reason is simple. If you break that candle into smaller time frames, you'll notice that its high and low frequently act as reaction or reversal points on those lower time frames. In the case of a daily candlestick, these points represent the highest and lowest prices traded during that specific day, highlighting how crucial they are. This means that even without zooming into smaller time frames, we can already identify where major liquidity levels are by analyzing a single candlestick. The upper boundary is known as the candle range high, CRH, while the lower boundary is the candle range low, CRL. You can apply this concept to any candle on any time frame. However, not every candle carries the same value for analysis. Certain characteristics make some candles more reliable than others, and we'll cover those ideal candle conditions later in this video. Now, if the second candle taps the liquidity above the candle range high, CR, and then reverses quickly, there's a high probability that the next objective will be the liquidity below the candle range low, CRL. In other words, a liquidity sweep of the CR implies that the market is likely to pivot and seek the liquidity sitting at the opposite end of the range. If instead, the second candle closes above the CR, the potential candle range theory setup is invalid. In that case, continuation to the upside is more likely than a move toward the low of the first candle's range. However, if the criteria are met and the second candle fails to close above the CR, we can shift focus to the third candle for a potential short setup, with the CRL as the primary target. That covers the core idea and the reasoning behind candle range theory. So if you're ready to deepen your market knowledge, sharpen your trading edge, and start making smarter investment decisions, don't miss the full video on our channel. Watch now.